Hello there, hope you're doing great as always. Just wanted to shoot you a quick video as always, even though I'm wicked tired today. But you know how the saying goes, if you're tired, then just do it tired. So, I was already on a bike today, did some boxing on a bike. But it's time to get to investing, right? Because hey, discipline is what makes us money at the end of the day, right? So let's get to it. So last time we were talking about some of the, we started to get a little bit more nuance, but now we are getting into the details, right? And so one of the things that I've learned over the years, over my 8 years of investing, and of course, it's not like my some secret thoughts. It's mainly based on some of the investing giants of the past, Warren Buffett, Peter Lynch, and just applying those principles on a contemporary landscape, right? So what's crucial when we want to invest in a great companies that will make us a lot of money over the years, right? Like here in my portfolio. Well, stellar management team is one of the important points, right? Because CEO is the captain of the ship we are buying. And that's actually a funny metaphor, right? Because how did the stock market get started? And this is actually quite a funny story, to be honest. So let me go for a little tangent here. Because actually, some of the earliest glimpses of something akin to stock market was back in the days, and I will probably mess up the exact details, but like in the 1600s there or 1500s, there were the, you know, ships going to the new world, trying to get the resources, get all of the exotic metals and spices and everything, right? And basically those, voyages needed to be funded somehow, right? So basically, wealthy people, pool their money and basically invest it in the ship captains, right? Who were, going on that voyage and, into the new world and hopefully bringing something back, right? So basically, those who funded the voyage, they were rewarded for that. That's the kind of the earliest, like a proto stock market, right? And then of course stock market in its real form, took more in like the 1800s, 1900s, right? And of course, it's a long history at this point. And so, and that captain of the ship is very important even in today's climate, right? So it's very important to listen what they and their team are saying, right? Because we are looking for a company that has management team with a proven track record, experience, and great dynamics, right? So oftentimes CEO can really make or break, your investments, right? Because there are so many ways how C-suite, contributes to betterment of the business. They bring their knowledge, unique view, as well as, kind of look ahead, prepare accordingly, right? So they are making lots of high level decisions, and so those high level decisions need to be of a highest of a quality, right? Because frankly they are just, like a good CEO, they just need to make couple of decisions a day, but they need to be powerful decisions, right? Same as when you're investing, right? There are so many companies to invest, but if you invest in the right company, you can, let's say, 10x your money, right? Someone, two stories, right? Someone 2 3 years ago who invested in Palantir versus someone who invested in Snowflake, right? One person is very happy and wealthy, the other person with Snowflake is just still nowhere, right? That's the power of decision, and that's why we have to train our judgment, right? So under a great CEO, company can reach the stars, right? Just look what, for example, Lisa Su did with AMD. When she became the CEO of AMD was a $2 check, right, in 2014-ish, right? And now it's, well, when I wrote it, it was 140. Right now it's a little less than that. But either way, sure, someone who bought AMD a year ago is down, maybe like roughly 30, 40, 50%, right? But someone who bought a decade ago, 50 bigger, right? Something along these lines. So yeah, I wish I was invested in AMD sooner, but hey, we live only forward, right? So there are always some good decisions that we can make today, right? And I will be making a new set of decisions this year and the year after, right? And we have to prepare to make those strong decisions. If we put 10,000 into a company, it can easily grow into 100K, potentially more. But we have to have the judgment. And so there are many great visionaries, right? And we want those people leading our companies, right? And on top of that, what's also super important is when management and shareholders are aligned and the right incentives are in place, right? So, because there are some, let me give you a counter example, right? For example, something like Snapchat is a company that's basically, just throwing money, into the pockets of management team, and there is very little left for the shareholders. Compared to some companies that are actually, put some incentives in place. So, for example, for SoFi Technologies, I'm not sure if you're aware, but CEO Anthony Noto, he has an incentive plan to get the stock price to certain levels by a certain date, right? And if he manages to do that, he gets extra bonuses, right? So his own interest is aligned with the shareholders because he is paid in stock and paid for performance. Same as Elon Musk was, his famous, pay package back in 2018-ish or something along these lines, right? Again, paying him extra for performance, right? For outperformance, for significant outperformance. And whoever invested in Tesla in 2018, they're also doing very great, right? Because management team was great and the incentives were aligned, right? So we're looking for that person on a mission, right? Person who has that skin in the game. Because many times, it has proven to be a great investment when the founders are still managing the company, right? Because founder in most cases cares about the company, right? It's their baby. So if you build an empire from rubble, you care about it and you want it to prosper, right? So, and it's no coincidence that lots of my, companies in my portfolio are founder-led companies, right? And of course, there are exceptions to the rule, but this is one of the, good rules of thumb, right? And, founder, if everything else equal, founder-led company should do better than, just some committee kind of company. And so that's why, for example, listening to conference call and paying extra attention, to the management team is, one of the crucial points, right? To capture some of these, small things. So that's one of the important principles, right? And secondly, the little side note here, right? So this is not related to the lesson number 3, but favorable environment, right? That's one of my next guiding principle, right? Because as Warren Buffett wrote in a letter, many, many years ago, never bet against the US cultural and economic behemoth that needs to be respected. The financial sector is strong, has a long tradition. United States has one of the most investor-friendly legal environments and track record of transparency, right? So you can say whatever you want, but US, of course, has its negatives, right? But it's still the cleanest shirt in the dirty laundry, right? So it's not a coincidence that the biggest companies are based in the US, right? When you talk all of the biggest companies, Magnificent Seven and everything, like basically, if I remember correctly, 7 out of 10 biggest companies in the world are, based in the US, except some, small, Aramco and things like that. So basically, due to socioeconomic conditions, United States are positioned for continuous strong growth over the coming decades, right? And again, you might, get tangled in the politics and everything, but still, like, what's the alternative, right? The country has always bred the most entrepreneurial minds and people with true grit, right? That perseverance, that's, fairly US-centric phenomenon, right? That unique mentality and hardship which many Americans encounter make the country stronger and more competitive at the end of the day, right? Because compare that to, for example, Europe, right? Where the overarching bureaucracy and unfair and, not really business-friendly conditions hinder that economic growth, right? Like there are no incentives for people to actually build the companies because they just get stifled by all of the bureaucracy, and people are like, hey, what are you doing, right? It's like it's not there. And of course, on the opposite spectrum, you might have some emerging countries which might appear appealing, yeah, and sometimes offer, strong growth opportunities. But the downside is that absence of that stable legal framework, sometimes corruption, opaque business structure. So it's risky. And sure, there are a small number of people, like if you really went, full into the foreign markets and find those gems, which is possible. But then it becomes more than a full-time job. You just really need to understand the local environment. I mean, I don't know about you, but I don't have time for that, right? I want to keep it somewhat simple, right? So US it is, right? So, we see United States as the most promising environment from a long-term risk-reward standpoint. And it's also that, continuing to focus on one market also, eventually compounds, right? So sure, if someone's, puts their effort into some foreign markets, it might as well bear the fruits. But hey, why make it more complicated than it needs to be? And number 4, align with super trends. Cool. So what do we mean there? Well, if we know what's going to happen, we can adequately position ourselves and profit from the ever-changing nature of reality, right? So the world is changing fast, changing even faster, and we have to swim in that current, right? We have to, surf that wave. It's a simple principle. We don't want to make it more complicated than it needs to be, right? If there is some industry that's poised to grow, well, we might as well become part of it, right? And frankly, I did not fully understand that impact of change, but I read this great book from Lars Tve. He's like a Danish investor, right? So of course the pronunciation is just like terrible, and I try to, throw my Danish pronunciation there. But he's actually, pretty cool guy, also investor, more like a macro guy. But he has his book called Super Trends, right? Which is actually a very nice collection of all of these, big changes, trends, and it really, provides quite a nice insight. So basically, disruption is real. And of course, sure, there are going to be bubbles and, sometimes a little bit leads us astray. But the world is changing, right? Every year, let's say something like, LLMs, right? AI, it only became popular just, 2-3 years ago, right? And it kind of appeared almost out of nowhere unless we were, paying attention, right? But it's happening. And so why would we go against it, right? So it's not really, it is not only about predicting the future, right? But also, in a sense, shape it by investing, right? Because there are those companies that are at the forefront of that change, right? So, in a sense, capital allocation is an art of changing the flow of resources where they are needed the most, right? So there are companies that deserve to get that capital because they are making the most change, and you want to make those best and brightest and give them that extra fuel, right? Because we are, at the end of the day, we are all voting how the future will play out. We are voting with our wallets, right? We decide what to buy, what services to use, where to spend our time, right? So both as an investor, what company are you investing in, but also as a consumer, right? If you're buying a certain product, you're basically putting your faith in that company that, hey, those guys are doing a great thing. They should get more, right? They should be incentivized. And so the future is the outcome of all decisions that are happening all around the world at the moment, right? So in simple terms, we should ignore industries that are dying or stagnant and focus on companies that are, again, positioning themselves to enjoy that growth. The world is moving in one direction only, forward. And so we are also seeking companies that have a long-term, sustainable competitive advantage, significant barriers of entry or wide moats around their business. And people sometimes make that, this is kind of classic, again, Warren Buffett, Peter Lynch type of discussion about moat. But people sometimes misinterpret this to a certain degree, right? Because, moat a little bit evokes something that's like, stable, you just build it once and that's it, you have the moat and cool. But the thing is, the moats are actually more ever-changing, right? It's not like you build the moat once and that's it. No, you have to continuously keep building the moat, right? So moat is more like a process thing, right? You have to keep improving, because if you don't, someone will come and figure out how to cross that moat of yours. So you constantly need to keep improving it, keep changing it. And moat can have many barriers, right? It could be, patents, could be reputation, could be strength of the brand, could be upfront capital required to enter the industry or well-connected management team, right? So, like there are many different examples, right? So it's also a little bit hard to evaluate this, because really company to company it's different, right? But usually those companies tend to be industry leaders that prove to be resilient and with limited exposure to outside factors, right? So there are certain companies that are just strengthening their moat and building the moat, right? So it's also sometimes about identifying companies that are there might still be, let's say, somewhat small and in the early stages of growth, and the moat is not there yet, but they are building the moat, right? So for example, I would say HIMS is a good example of that, right? Where frankly I was looking into that company already for a number of years, and I wasn't really into it for quite a long time because I did not see that proof of the moat yet. But now I would say HIMS is actually building a pretty strong moat with that customer personalization, right? Compounding that goodwill. So that's a good example of moat in progress in my mind, right? So if the customers are treated right and they are really getting that personalized treatment, it makes it sticky. The customers keep returning, keep spending money. Great, right? And so we're always thrilled to work with some A-class players who are aiming to outperform, right? Those who challenge the status quo. We don't want the next something. We want the thing, right? The leader that is being copied, imitated, and attacked, right? So you want to be that number one guy, you want to be the Palantir, someone who's doing things completely differently, and people are only trying to copy and maybe get to 1/10 of what you're doing, right? You want to be the, HIMS, right, that are, again, really building that moat. So, yeah, that's it, right? And one more point probably for today. Let's keep it, again, under those 30 minutes. Number 5, concentrated portfolio, right? Again, going back to Warren Buffett, what I'm saying here is oftentimes just repeating some of the old principles and making sure those values are passed on, right? Because what Warren Buffett basically said is that diversification is a protection against ignorance, right? And even at this time, right, Warren Buffett still has his biggest, basically third of his public portfolio is in Apple, right? And of course he has, now Berkshire is a huge conglomerate. They have lots of companies that are like fully owned. But the part of, only partial ownership of the companies, third is in the Apple, right? He's still, even at 90 years old, he's betting big, right? If you have 30 companies, you probably don't have enough brain power to understand all of them in depth, right? So what did Warren Buffett specifically mean? Well, it's pretty simple. Once we have, put a little common sense there, because as an investor, our number one priority is to understand the companies we want to be involved with. Can we have a proper understanding of more than 15 companies? 20, 25? Probably not, right? So even if we could, why would we want more, right? We want to own the number one player in the industry. We want to go with our best ideas, right? Not with the 20th best idea, right? Something that we overheard somewhere and put few thousand there. No. Why would I want to just dilute? No. So we are looking for creme de la creme, right? Because also statistically speaking, as Joel Greenblatt concluded during his fruitful career and proved mathematically, right? By holding just 8 companies, you eliminate 81% of the risk compared to owning just one stock. So sure, if you have 2-3 companies, you're on that risky end. Not really good. But if you're getting, 15, 20, 25, what are we doing here, right? You might just buy an index at this point. So, I would say 7, 12, maybe 15. It's kind of like ideal. Of course, if you have a bigger portfolio, eventually you might want, when you want to, like a little bit, play it more safer and maybe a little bit, step away from investing, fair enough. But if we are in that, if we want to grow our portfolio, we have to prioritize, optimize, right? So really looking for the best companies, right? Not looking for leftovers. And another side note here, war chest, right? So of course, Mr. Market is a moody fellow, right? One day it tries to sell you plucked chicken for a fortune, and next day it might serve you roasted ribs for a dime. what do we mean with this, funny? Oh, I hope it's funny. But basically, the market, of course, does what the market's doing, right? It goes up and down depending on these days, depending on tweets or, interest rates or, what the tariffs are. There is always something to be scared about. So for those cases, we always want to have a little bit of money on the sidelines, right? I would call it a war chest. And when there is a blood on the street, we reach into the chest and start buying. Even though we might be bleeding ourselves with the crowd, right? Catching those falling knives. And this approach, worked great for me, to be honest, right? Because, for example, in the Corona crash back in spring 2020, the market was plummeting, my portfolio was plummeting as well. So, my portfolio dropped like 40%, but I had some, 20, 30% cash on the sidelines, right? So I gobbled up some of those stocks of several great companies, around that bottom, April, going into the summer. And of course, I did not time it perfectly, right? But I was somewhere there, right? I was buying around the bottom, right? And then of course market recovered and my portfolio recovered, and those companies that I've gobbled up, near the bottom, they more than doubled, right? So, like things like that, like we need to be prepared, right? So that's why we always keep 10, 20%, maybe sometimes 30%. And now of course we are getting a little bit of a nuances, and it would make for a standalone lesson just to work with that cash position. But yeah, that's it, right? So we have to be a little bit more prepared, and that's also for, of course, a little bit more experienced investor, right? So of course when we are new, it's just best to invest, stable every month, every 2 weeks. But once we get more experience, understand these nuances, this war chest here is what can help us to improve our performance, right? By being more opportunistic, by buying the companies when they are at a proper discount, right? So, for example, one of the, because there are also some of the mistakes that I'm kind of made, right? For example, with Meta, I had that position for a relatively longer period of time. But back when Meta dipped under 100, I wasn't really doing anything. And sure, I was buying, different companies, and I did great on those. I was mainly focused on Palantir back then, but it was one of the opportunities, right? Sometimes the companies get at really, undervalued territory. Meta in 100 was the case. Cool, right? And for things like that, we have to be prepared, right? And we cannot be just like the average guy waiting for someone to hand us the fish. We have to learn how to become that fisherman. So yeah, I think that's enough for today. Seems like it's going to be even more lessons, but I always, catch some fire when I start to talk about investing. So hope this was helpful. Appreciate you. Take it easy.